What's driving markets? Welcome to Market Take. Each week we'll bring you our insights on the latest market and economic trends impacting investments. I'm your host, Vivek Paul, Head of Portfolio Research within the BlackRock Investment Institute, and this week I'll be discussing our strategic or long-term views of 5 years and beyond. Elevated levels of bond volatility are evidence of the new macro market regime in action and confirm the benefits of being agile with our strategic views of 5 years or longer. We upgrade sovereign bonds in developed markets to neutral, but this masks two stories. We stay underweight long-term bonds but turn overweight short and mid-dated bonds. We also trim our preference for inflation-linked bonds, though this remains our largest overweight, and cut DM stocks to neutral. Here's why. Our 3.5-year underweight to all DM government bonds is over, as market yields have risen in line with our positioning. At an aggregate level, we have turned neutral, but this is driven by a preference for short and mid-maturity bonds, and what's more noteworthy is what we didn't shift. We remain underweight long-term bonds. Why? We think long-term yields will resume their climb as investors demand more term premium compensation for the risk of holding long-term bonds. We believe higher inflation plus greater fiscal and climate-related spending likely mean the level of policy rates will be materially higher than before the pandemic. Our updated view of higher neutral rates in the long term prompts a reassessment of equity valuations. Our strategic overweight to DM stocks, which we've held since before the end of Western lockdowns, is now trimmed to neutral. Long-term stock valuations look about fair to us, rather than warranting a higher allocation than usual. So even with the downgrade to neutral, US stocks remain our largest portfolio allocation. Despite a small reduction in our inflation-linked bond overweight, it remains our highest conviction view given our inflation outlook. Here's our market take. We think the new volatile economic regime calls for more nimble and dynamic strategic views. We go neutral developed market government bonds, a combination of being underweight long-term bonds and overweight short and mid-maturities. We go neutral developed market equities, but they retain their position as the largest capital allocation in our portfolios. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com.